All right, hey everybody. Today we're going to wrap up corporations, so we'll talk about corporate management, and then I might be able to just include the exam prep on this one. I might make a new one for that. All right, so let's jump right in. I'm going to share my screen here with the corporate management slides. And we start off with this discussion about shareholder meetings. Now on this slide, on this picture, I've got kind of what the Walmart annual shareholder meeting looks like. It's basically a massive party. And I know this, incidentally, by accident. When I was a new attorney, I was working in Florida, but I had to do all of these appeals around the country. And one of them was in Little Rock, Arkansas. And then the next day I had to be in this tiny town in Oklahoma called Miami, but it's spelled Miami, but they say Miami or something. Anyway, and it took me through Bentonville, Arkansas, which is where Walmart is headquartered. And anyway, at this point I knew nothing about the Walmart shareholder party extravaganza, I don't know, whatever you want to call it. I was just trying to get to Oklahoma, and all of a sudden there was all this traffic. My hotel was absolutely packed. And everybody's asking me like, what was my favorite concert of that day? And I'm like, I don't know what you people are talking about. But it's because they were all there in Bentonville for the annual shareholder meeting. And anyway, at this shareholder, I mean, they have concerts and stuff. And so Katy Perry's always there, and like all the celebrities that usually during the year ream on Walmart, call it a wicked, evil corporation. But then, if they're getting paid, they'll go sing there or whatever. And anyway, now I get to hear about it because my brother-in-law is kind of in the accounting department there at Walmart. And so my sister is sending me pictures of like her hanging out with, all these stars and stuff. I'm like, yeah, cool. But you still have to live in Bentonville. So, all right. So these shareholder meetings, these are required by law under the corporate statutes. They have to happen at least once a year. This gives shareholders an opportunity to, one, vote for the board of directors, which we talked about last time. And if they can't go, then the shareholders can vote by proxy. So if you are a shareholder of Walmart, chances are like not every shareholder of Walmart is going to be able to go to the annual meeting. Bentonville just couldn't, like you can see on this picture that they can fit a lot of people in there, but not that many people. So when you get the notice of the annual meeting, you can often sign over a proxy allowing an institutional investor or somebody to vote for you, vote your share. And if you can get enough people to sign their proxy over to you, then you may only have 100 shares of Walmart, which isn't going to do squat. But if you get a ton of people to give you a proxy, then that opens doors. Now you can vote and have some influence over who gets on the board of directors. Okay, so now, sorry, I'm playing around with my picture. All right, shareholder voting. So kind of the idea here is that for shareholders to be able to vote, you need at least 50% of the outstanding shares. Now, this is true unless the bylaws say differently. So the bylaws can say something like 5% shareholders need to be there. But if the bylaws are silent, then we look to the Corporate Act in the state where the corporation is registered, and those usually say like if the bylaws are silent, you need 50%, or more than you need one more, like 51% of the outstanding shares need to be present for that vote to happen. And then with that voting, usually, unless the bylaws say differently, you only need 51% of the votes to say yay or nay for a vote to pass. This this slide, we're mostly talking about smaller, like closed corporations or C corps, as we typically call them. These are those smaller family businesses, um, and yeah, then but then we've got this idea of cumulative voting. That's the last button on this slide, and cumulative voting is interesting. This takes place with usually larger corporations, and the idea is that instead of like one vote or one share equals one vote, so let's say you've got 3 people that are running uh, for an open seat on the board. Well, normally, like, your one share equals one vote, so you can vote for one of those 3 people. Cumulative voting changes this a little bit. And what it does is it for every for every share, you get the number of votes as there are people running. So under that same hypothetical, I could say, I have one share and there are 3 people voting, so I get 3 votes, and I can vote 1 for each person, or I could vote 2 for one person, 1 vote for another person, and 0 votes for the other, or I can give all 3 votes are going to Jane. And what this does is it allows minority shareholders to group together their votes, and it gives them a shot of being able to put somebody on the board. This is really interesting. I'm not going to test on it, but if you're interested in this and kind of shareholder activism, I would look at YouTube. Has a number of great videos explaining cumulative voting a little better. Okay, shareholder derivative suits we got into last class, but this is the idea that shareholders can sue the company, or not even just, but like when I say shareholders, you think like, oh, all the shareholders have to get together to sue the company. No, it could be just one shareholder. Can bring a lawsuit against the corporation and its board and officers, claiming that they took some action that was detrimental to the corporation and that they were injured because they're a shareholder, they're an owner of the business, and as a result of somebody's either fraud or gross negligence or criminal activity, that they were injured because their share price was worth $100 a share and now it's $80 a share. And so what is required, and in the last video, I talked to you about how this was a part of my early practice when I was clerking at a firm in San Diego. This is what we did. So you do have to make a written demand to the board first, saying, I'm going to bring a lawsuit against you. Here are my demands. Gives them an opportunity to settle before the lawsuit is brought. But assuming that it isn't, then the lawsuit can go forward. Now I'm skipping a lot of technicalities and kind of big issues in between. But once you bring the lawsuit, then if you win, what happens is the company has to reimburse and may be required to take out of its funds money to replace the money lost by the shareholders as a result of this. It also opens up the board and the officers to personal liability if their actions violated any of the duties that we talked about in the last class. All right. Okay, and at this point now we get into investor protections, and primarily we're talking about the Securities Act of 1933. This was designed after the Great, during the Great Depression, but after the big economic shock where the stock market crashed. And the idea here was to, if you remember much from your history classes about this, there was very little regulation. People were buying and selling shares, making lots of money very quickly. But it soon became clear that this was all fake. Like, everybody was so excited about a certain stock. Well, one, they were being lied to. The company was committing fraud by saying that they were more profitable than they were. And you just had people becoming millionaires very quickly based on nothing. I mean, the companies were often losing money. They basically created a pyramid scheme where they were making more money by selling shares and kind of propping the company based off of their fraud. And so the Securities Act came in to reinstate confidence in the stock market. And it did a great job. Starting in the 30s through the 60s, the US became really the sole financial power of the world. And part of that was due to the Securities Act. World War II had something to do with it too. But the Securities Act ensured that the government was overseeing and making sure that there wasn't fraud taking place anymore. And that gave people more confidence, and they could invest knowing that the company that they were investing in wasn't lying on their financials. And so that was comforting and led to more a promising outlook with the stock market and its recovery in the 1930s. So really one major element of this was that it banned insider trading, meaning that if you are an insider with a company, a member of the board or an officer, and you receive information about the company, good or bad, that you are not allowed to act on that information with stock. And I think a good way to explain this is during the last lecture, I mentioned the Deepwater Horizon, the explosion in the Gulf, and I had erroneously thought that we'd already talked about it. We haven't, so now is when I'm going to talk about it. So British Petroleum, BP, had leased this oil rig, or platform, I should say, in the Gulf of Mexico. The platform was created by a company out of South Korea. BP was leasing it, meaning they were operating it, pulling the oil from the bottom of the Gulf floor and bringing it up and selling it, making money. I don't know if you remember this. This wasn't that long ago, but this would have been like 2009. Yeah, 2009 or 2010. But what happened is a gas bubble formed in the pipes, and as it came up through the pipes, it caused an explosion. Well, it caused a rupture first. That caused an explosion up on the platform, and all of a sudden, the platform is, as you can see in this picture, just ablaze. Now, one of the VPs so an executive, his name was Keith Silhan. Let's just call him Keith. Keith worked for BP. He was one of the executives. And as soon as there was an explosion, it was his job to go investigate and see what was going on. So Keith goes out to the Deepwater Horizon while all of these other boats are trying to put out the fire. He gets there in a helicopter, is observing what's going on, and they're able to put the fire out. But it wasn't like that was the end of it, because they put the fire out. Keith starts talking to some of the engineers, and they said, yeah, like this is a major problem. Not like, sure, we got the fire put out here, but we are spewing millions of gallons of oil onto the seafloor, like 2 miles down or however deep this thing was. And Keith was like, holy crap. So Keith gets on his cell phone in the middle of the Gulf of Mexico, gets on the phone, calls his wife back in London and says, honey, sell all of our stock in BP right now. And she does it. All right. So his wife, I'm going to make this a little bigger. So his wife sells all of their BP stock. They had about $1 million worth of BP, British Petroleum stock, sold all of it that day. And then the next day, the news came out that of what was going on, that there was a major oil spill in the Gulf of Mexico. BP was the one operating the platform, and BP's stock started dropping like crazy the next day. Because he sold it the day before, Keith and his wife saved about $100,000 by selling it the day before. But as you know from my definition of insider trading, he's going to be in trouble for all of this. So about a month later, Keith gets a knock on the door, and it's the Securities and Exchange Commission, the SEC, saying, hi, Keith, we'd like to talk to you. At which point they kind of went over the evidence with him and his attorney, and he settled very quickly. Now, what's interesting about this is, yes, he saved about $100,000 by selling all of his stock. But when the SEC came to fine him, he had to pay $200,000. And that's because he had to give back all of the losses. So the $100,000, he also had to pay interest on that. And he had to pay the SEC for their trouble. And they had attorneys on this and staff on this for a month or so investigating it. And so that's why it was over 200. I think it was like closer to $250,000 that Keith and his wife had to pay the SEC to settle this and potentially not go to jail. Now, you've heard of Martha Stewart. She went to jail, although she didn't really go to jail for insider trading, although that's possible to go to jail for insider trading. But she got, she was in trouble because she lied to investigators. And that's why she ended up spending some time in jail. So anyway, this is important that you understand what insider trading is, to watch out for it. If you are an executive, if you are a board of director, if you are an officer, not a shareholder, but if you are in a position of authority in a corporation and use inside knowledge to your benefit, we can see why this is a problem. You're cheating somebody else that didn't know it. Like, sure, I may have seen that the Deepwater Horizon had an explosion on the platform, but nobody in the world knew about the problems going on 2 miles under the surface of the water. And so if you know about that and then use it and you sell your stock and save $100,000, well, that's $100,000 at my expense because I also own BP, but I wasn't privileged to that information. And so basically you cheated me out of some amount of money. And that's why insider trading is such a serious issue. Okay, this gets us to the idea of like, well, insider trading deals with securities, but what the heck is a security? Well, I think most of us understand that securities include stocks. That's like very common, probably the most common security that you have with business entities is some type of ownership share, like a stock. So I list that out as stocks, bonds. But it can be some of these other things that are less clear, like notes or other, and some of you are like, what the heck, what does Brother Hales mean by a note? A note is just a document that evidences some form of debt. So if I lend you money, I will, and so I give you $100,000. I'll have you sign a note. The note is what evidences the fact that you owe me money. Now that note, I can also secure it. And if you go back to secure transactions, I can fill out a financing statement, the UCC that we talked about in class. So that can also be a security, are those notes, if it's tied to a business interest. Okay, so what is a security? Well, it's a lot of things. As you can tell from this slide, it's a number of different things. So if we go to this slide, a registration statement is required if you are going to have securities involved in a transaction. So what this means is, if I'm going to sell you an interest in my company, well, that's a security. That's basically a stock is what I'm selling you. And so, but if I'm going to open this up to the public, meaning like now it's not a C Corp, it's not a closed corporation. It's not just me and my wife and an uncle with a business. Now I'm going to start opening ownership to the general public. Well, now I'm going to have to register these securities, these ownership interests, with the Securities and Exchange Commission. Okay, so this is the registration statement. This is just outlines the kind of what is going on, what ownership interests are worth, like the units, And anyway, the second sub bullet point here is that you must provide all investors with a prospectus. Some of you have seen these before. If you own stock, you'll get a big stack of papers. That is the prospectus. These say things like, you know, ownership in this company is not guaranteed to make a profit. You can lose money, blah, 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 blah. It'll go over risks. It'll go over the issues that the company's facing. That's the prospectus. Most people don't read this stuff. And then you've got the registration statement describing what securities are offered. And we already talked about that, as well as the prospectus. So I'll move on here. But not all securities are required to be registered with the SEC. Some are exempt properties. Now, I think at this point, I think a good thing to do would be to go to TopHat, and we can start going over some of the questions from all of this unit, including the security stuff that we're talking about right now. I think this will allow you to kind of get a good feel for what's going on. So if I go to Unit 5, let's just do a bunch of TopHat questions right now. So let me make this bigger. Okay. All right, so let's start here. Slater wants to open a surf shop in Cocoa Beach, Florida. His best friend Machado wants to help fund the enterprise, but does not have time to assist in the management of the company due to his hectic surf schedule. Because they did not speak to an attorney, they did not know a business entity would best serve their needs, so they went with a limited partnership, an LP. Shortly after launching the business, Hopgood, their top sponsored surfer, falls ill with shingles due to the resin used in the boards. Lawsuits follow. If the limited partnership is found liable and can't pay the full amount owed, all right, here's your options. Only Machado will be held liable. Both will be held liable because it's a partnership. Only Slater will be held liable, and neither are liable because they formed an LP. All right, so with this one, there's a couple keys here. Slater wants to open it up. Machado wants to help fund it, but doesn't have time to assist in the management. Remember, it's an LP, meaning Slater's going to run it. He's the general partner. Machado is going to be the limited partner because he's given in the money, but he's not going to run it. All right, somebody gets injured because of the surfboards. So who's liable here? Well, only Machado will be held liable. Remember, he's the limited partner. That's not right. Okay. Both will be held liable because it's a partnership. If it was a general partnership, yes, but this is not a general partnership. It's a limited partnership. C, only Slater will be held liable. That's going to be your correct answer. D, because again, Slater's the general partner. All right, D, neither are liable because they formed an LP. Nope, not true. With a limited partnership, the general partner is personally liable. So C is going to be the right answer. All right, now we can get to securities, what we were just talking about. So Elliott purchases a large plot of land near Driggs, Idaho. He then develops the land in preparation to sell individual lots with incredible views of the Tetons. To generate sales, he flies out wealthy individuals from around the country to view this investment opportunity of a lifetime. Okay, some individuals purchase lots, others don't. Has Elliott violated securities law? Well, he may have if this is determined to be a security and he didn't register with the SEC. All right, so the question is this a security? Now it sounds like it because he's saying like, hey, buy this land. It's an investment of a lifetime. The question is it an investment in an ownership interest of a business? And the answer is no. So not all, like sometimes we call things investments. It doesn't make them securities because if they were securities, we'd have to register them with the SEC. So again, the answer here is going to be A, no, because no securities were offered. But let's go through these so I make sure that you understand these correctly. B, yes, because he offered securities without providing a prospectus. Could be if this was if it was a security. No, because securities laws exempt purchases of land. Nope. Yes, because of his sales puffing. Nope, that's not going to be correct either. It's just because it wasn't a security. So that's kind of what I need you to remember with that one. All right, let's jump down to partnership liability. So here we've got Andy and Brandon. They form a partnership to find lucha libre and Rigby on the weekends. They share profits which have been flowing ever since. On Monday, Andy frequently holds up a sign in Brother Hale's class that says, "You'll never be able to afford an Aston Martin," causing Hale's severe emotional distress. So again, somebody's making fun of me in class, and that hurts me, right? So I want to sue them. Now, Andy's the one doing it, so can I sue Andy? So let's say that I do. I sue Andy and I get a $2 million judgment. Clearly, this isn't in Idaho anymore. I must have done this in California. But when I go to collect from Andy, he's only got like 10 boxes of ramen or something worth $10. That's all that I can get out of Andy. So the question is, can I sue Brandon? Well, you remember when we talked about partnerships that I said, if I don't say which kind of partnership it is, it's going to be a general partnership where both partners are liable for the acts of the other within the scope of their business. So what that means is well, let's go through the answers here. I can collect from the partnership. Well, I can collect from the partnership, assuming that Andy was working within the scope of his partnership when he made fun of me in class. He wasn't. This had nothing to do with the partnership. Remember, the partnership is fighting in Rigby. It has nothing to do with my class. So that's why I'm not going to be able to collect from the partnership. B, just cry in his office. We'll come back to that one. C, I can collect from the partnership or from Brandon. Now, this is true, assuming that Andy injured me within the scope of his partnership, which he did not. So that's why that's not going to be correct. And D, collect from Andy's parents. I'm assuming Andy is an 18-year-old. I'm not going to be able to collect from his parents. So that leaves us with B. The only thing that I can do in this case is just cry in my office. I got a $2 million judgment and I collected 10 bucks. That's it. That's all I can do. So that's going to be the right answer there. All right. This next one, registered agent. This will be a good one for you. All right. Thor serves as the registered agent for Valhalla LLC. Thor is responsible for registering Valhalla LLC, is an officer of Valhalla, may transact business for Valhalla, or D, must be willing to accept service of process for Valhalla. Remember, if you're an agent of Valhalla, then you can transact business, blah, 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 blah. But if you're a registered agent, that means something totally different. A registered agent exists only for D, accepting service of process if the company itself gets sued. That's it, okay? So a registered agent can't transact business, is not an officer, and is not responsible for registering the LLC. All they do is accept service of process. Please remember that one for the exam. All right, corporate tax. This, I just need you to know a very little bit about corporate tax. And for this, I think what's the most important thing to understand is, like I said, next section, we get into more detail with tax, but what you need to understand with this is, here, I'm going to create another whiteboard so you can see this. Let's say we've got a corporation up here, and the corporation made $100,000. All right, and then it distributes income to the partners themselves. All right, here's the deal with all of this. Corporations, unlike partnerships, they're going to pay tax right off the top. So these aren't the right numbers. We'll get to that next time. But let's say that the corporate tax is, let's just say it's the old number. It's 39%, right? Well, here, I'm going to make things easy. Let's say it's a 30% tax rate, which means they pay 30 grand, the corporation pays 30 grand in taxes, leaving $70,000 for the two shareholders. This is a small C Corp. So let's see, that's 70,000 divided by 2 is 35,000 because I'm good at math. 35K goes to one shareholder, and 35, because these are equal shareholders. 35K goes to the other, and then these individuals will pay tax again on their distributive share. So if I got $35,000 from my corporation 1 year, I'm going to pay my taxes on that at my own personal rate, which may be anywhere from 11 to 36%. Yeah, something like that. All right, so that's what we mean by the double taxation. So let's just say my personal tax rate is 20%. The double taxation occurs here on the personal level and here at the corporate level. So that's what we're looking at. That's corporate tax. So if we come back now, back to the slide itself, to the question itself, we've got Aaliyah, and Aspirin with Shoot 'em Up Incorporated, hunting wild game in Swaziland. The corporation makes $500,000. Aaliyah and Aspen both take $100,000 in dividends. How will the parties be taxed? Well, the corporation is going to be taxed on the $500K, and Aaliyah and Aspen will pay tax on their $100,000 each. A is going to be the correct answer here. Why? Because I just went over it. We're all good. All right, and then this one is so important for life and for the exam. And this is liability for your own negligence. So Melissa has set up Fishy Accounting PLLC, a professional limited liability company. It's just a LLC. And she's doing accounting. In the course of her work, she misses a large deduction, increasing her client's tax liability by $1 million. Her client sues Melissa, seeking damages. And so Fishy Accounting PLLC has bank accounts worth $250,000, other personal property assets worth $250,000, like computers and stuff like that. And Melissa personally owns an Aston Martin V12 Vantage worth $250,000 and a family bank account worth $250,000. If you did the math with me, you see this all adds up to $1 million. All right, so what will the client be able to collect? Well, just the assets owned by Fishy Accounting PLLC. So just the business bank account and the other personal property. So $500,000. Can they only get that? No, and we'll talk about why in a second. B, everything listed. That's going to be the right answer. So stick with me here. Well, the other two don't even make sense. The key here is that it was Melissa that made the mistake. So she's always going to be personally liable for her own mistake. That's the cost of doing business. You're always personally liable for your own wrongful acts. So as a result of that, everything listed is going to be at risk here. She could lose her car, her family bank account, as well as the business assets. Now, some students are like, well, what the heck? Like, why would I even form a business if I'm not going to get any liability protection? Well, I think you know by now, you form a business entity for liability protection, because what if somebody else in the business injures somebody? What if it's a partner of yours? What if it's an employee? Any of those things may negate your own personal liability. And that's why you form an LLC or a corporation for that personal protection. Okay, finally, all right, I think we did all of those. So, yep. All right, so that's all the TopHat. So what I'm going to do is I'm going to end this lecture now. This ends our lectures for business entities. And now I'll make a new video for the study session. So I'll get right on that, and I'll see you soon.